Now, sometimes we want to compare financial statements of different companies. However, this is impossible because of the difference in size. Also, we might want to see the trend of a firm to determine its performance over a period of years. Ratio analysis is a way of comparing companies between them and over time. They are very useful to both internal management and external parties such as investors, analysts, and creditors. However, a note of warning here, because we have so many accounting numbers in the financial statements, there are many possible ratios out there. Which one is better? Also, some ratios are computed in different ways, so the analysis can be misleading. When comparing ratios for different companies, make sure you read the notes to their individual financial statements to determine how those ratios have been calculated. As we look at each ratio, ask yourself what is it trying to measure and why is that information important. These are the major categories of financial ratios and are grouped into 5 groups. We have liquidity or short-term solvency ratios, which measure the company's ability to satisfy its short-term obligation as they come due. Activity or turnover ratios measure the speed at which a company converts various accounts into sales or cash. Debt or financial leverage ratio measures the proportion of total assets financed by company's creditors. Profitability ratios relate a company's earnings to its sales, assets, or equity. And last, the market value ratios relate a company's market value to certain accounting values. These ratios in the following slides will be computed using the information from the sample balance sheet and income statement presented in the previous slides. And we start with liquidity ratios. Liquidity or short-term solvency ratios give us an indication of cash flow problems. The current ratio for Global Petroleum Corporation is 1.10. Of course, the higher the ratio, the better. However, it depends on the industry. For example, a manufacturing company that requires more liquidity might consider this ratio unacceptable. 1.1 current ratio means that for every dollar in current liabilities, we have $1.10 of current assets. If we're to pay all our current debt now, we would be left with 10 cents per dollar. The quick ratio, or also known as the acid test ratio, excludes inventory because it's the least liquid of current assets. It provides a better measure of liquidity only if inventory cannot be easily converted to cash. However, if inventory is fairly liquid, then the current ratio will do. In our example, petroleum products are very liquid, so there is no problem. Also, the quick ratio is used to highlight large inventories as a result of overestimating sales and overbought and overproduced inventories. We call for working capital management the management of short-term investment and financing of a company. Things like cash and cash equivalents, inventory, accounts receivable, accounts payable, short-term loans, etc. The goals of working capital management is to ensure that there is adequate cash flow from operations and to find the most productive use of resources. Working capital management is important because it manages the liquidity of the firm by addressing the drags and pulls on liquidity. Drags on liquidity are forces that delay the collection of cash, such as slow payments by customer and obsolete inventory. Pulls on liquidity are decisions that result in paying cash too soon, such as settling accounts payable early or a bank reducing a line of credit. Primary sources of liquidity represent the most readily accessible funds available. Things like ready cash balances, short-term funds, and cash flow management. Secondary sources of liquidity may result in a change in the firm's financial and operating position because it involves things like renegotiating debt contracts, which means relieving pressure from high interest payments, or liquidating assets, but this depends on how quickly they can be converted to cash, filing for bankruptcy protection and reorganizing. This use of secondary sources is a signal that the company's financial health is worsening. The activity ratios measure how efficiently the company manages its assets, receivables, and payables. In other words, the speed to which various accounts are converted to cash. Inventory turnover measure how quickly the company sells its goods. The inventory value is the ending balance on the figure in the 2012 balance sheet. 13.85 means that the company sells its inventory 13.85 times each year, slightly more than once per month. The number of days of inventory is the average time it takes to acquire, process, and distribute the inventory. It's also known as the average inventory period, inventory holding period, and is the length of time the inventory remains within the company during the fiscal period. In our example, the inventory sits in the company for about 26 days before it gets sold. The average collection and payment periods are useful to know when evaluating credit and collection policies. If, for example, the company extends 30-day credit terms to customers and the collection period is 46 days, it means that invoices are paid too slow and the collection department is doing a poor job, as this might affect the cash at bank balance. The fixed and total asset turnover ratios have the same numerator, that is, sales. It tells us how much sales can the company turn over based on some asset measure, how much sales it generates from its assets. So for every dollar in net fixed assets, there are $1.91 in sales. In other words, fixed assets have been turned over about 1.9 times. And for every dollar in total asset, the company generates $1.34 in sales. Total assets have been turned over 1.34 times per year. Of course, we want these ratios to be high, which means that assets have been managed well. They have been turned over many times to generate sales. The working capital effectiveness of a company can be evaluated based on its operating and cash conversion cycles. The company's effectiveness can then be compared with that of peer companies or industries to see how well they manage liquidity. The operating cycle is the length of time it takes a company's investment in inventory to be collected in cash from its customers. The net operating cycle, or the cash conversion cycle, is the length of time it takes for a company's investment in inventory to generate cash, considering that some or all of the inventory is purchased using credit. The length of the company's operating and cash conversion cycles is a factor that determines how much liquidity a company needs. Thus, the longer the cycle, the greater the company's need for liquidity. Now, using the activity ratios calculated previously, we can calculate the operating and cash conversion cycles for this company. The operating cycle indicates the length of time that cash is invested in current assets other than cash, how long it takes to convert inventory and accounts receivable into cash. In our example, the company takes about 72 days to convert inventory and accounts receivable into cash. The cash conversion cycle is useful when the company acquires inventory using trade credit or accounts payables. The cash conversion cycle, or CCC, is the theoretical amount of time between a company spending cash and receiving cash per each sale or output or unit of operation or other item. It is basically a measure of how long cash is tied up in working capital, and this figure can be positive or negative. A positive cash cycle, cash conversion cycle, means at current state of operation, entity is taking more time to generate cash as compared to the time required to make payments. Positive cash cycles do not necessarily result from increasing conversion time or delayed payments from customers. It may be, perhaps, because creditors are now asking for quick payments, and that's why the cycle becomes larger and larger. Negative cash cycle is completely opposite from the above situation. It means the company collects cash faster than it pays. In our example, the company has a negative number for its cash conversion cycle. It means cash is not tied very much in working capital. You don't see this very often, but definitely it's a win for this company's shareholders. However, not for the suppliers who are waiting for their checks. The length of time associated with a segment in the cycle varies among companies and industries. The profitability ratios shows us how efficiently the firm manages its operations and how efficiently it uses its assets to derive the profit. Depending on the measure of income, you have gross profit, operating profit, or net profit margin. Let's look at the operating profit margin, which is a measure of operating efficiency. It measures how well the firm controls the costs required to generate the operating profit. It tells how much the firm earns for every dollar in sales, less all costs associated with production, other than interest and taxes. In the example, the firm earns almost 12 cents for each dollar in sales. The higher the ratio, the better it controls the costs with the same sales. One of the most closely watched ratio is the earning per share, the EPS, which is an indication of how successful the company is. There are $5.29 earned for each share outstanding. Return on asset is sometimes referred as return on investment, because your assets are your investments and measures the management effectiveness in using companies' assets to generate returns for shareholders. As with many of the ratios, there are variations in how this can be calculated. The most important thing is to make sure that you are computing them the same way as the benchmark you're using. So if you are comparing your company with the competitor, make sure both are calculated the same way. The last ratio, return on equity, will always be higher than return on assets as long as there is debt in the firm, because assets are equal to equity and debt. The greater the leverage or the debt usage, the larger the difference will be between these two ratios. Return on equity is often used as a measure of how well management is attaining the goal of owner wealth maximization. It tells us that for every dollar of equity that shareholders have invested, the return is 22 cents. Return on equity is quite important as it represents the return to shareholders, and therefore managers perform a deeper analysis to uncover the drivers behind these ratios. The DuPont system approach breaks the return on equity into components to see where the returns come from the most. First, we take the return on equity in the simplest form and multiply both top and bottom by total assets. When rearranging, we observe that this is equivalent to the return on assets multiplied by total assets divided by equity, or the equity multiplier. So the difference between the return on assets and the return on equity is the equity multiplier, or the use of debt. Then we take return on assets and multiply top and bottom by sales. And again, by rearranging, we get to the DuPont identity, which is named after DuPont Corporation, which made its use popular. We observe that the components or the drivers of the return on equity are the net profit margin, or the operating efficiency, which ties to the income statement, the total asset turnover or asset use efficiency ties it to the balance sheet, and the equity multiplier, or the use of debt or financial leverage. Irrespective of the way you calculate return on equity, both figures, the original condensed version and the extended DuPont version, should give you the same result. Last set of ratios, the market ratios, use a non-accounting number, the market price per share, which implies that these ratios can only be calculated for publicly listed companies. These ratios shows how investors think the company is performing. The price of one share for Global Petroleum Corporation as at 30th of June 2012 was $76.25. Having calculated earnings per share on a previous slide, we can go on and calculate the price-earnings ratio, which is the most quoted ratio in the financial circles. P/E ratio measures the company's long-term growth prospects, as it represents how much investors are willing to pay for $1 of earnings. There are many ways you can interpret this P/E ratio. We can say that shares carry or have a multiple of 14.4. Or we can say that shares sell for 14 times earnings. Or for every $1 of earnings, investors are willing to pay $14.4. Therefore, a higher PE is desirable because the firm has significant prospects for future growth if the investors are willing to pay that much. However, you have to be careful how you interpret this ratio, as a higher PE can also mean that the firm has little earnings. So look behind the scenes at the calculation and see the components of PE ratio. The market-to-book ratio is another assessment of how investors view the performance of the company, as it relates the market value of a share with its book value. So first we calculate the book value per share, calculated as the total share equity divided by number of shares outstanding. And we use that in calculating the market-to-book ratio. The ratio tells us that for every dollar in book value, the investors are willing to pay $3.19. They are willing to pay more than the book value for the company's shares. So the book value reflects the historical cost, and in a way, this ratio compares the market value of a firm's investment with its cost, with its original cost book value, to determine if the company has created value for its shareholders. Therefore, a value less than 1 means that there has been no value created for the shareholders. Again, the higher the ratio, the better. Now, on their own, ratios are meaningless. To be useful in the analysis, we must compare them with similar ratios. And this can be done as a time trend analysis for the same company over a period of time. For example, we look at the profit margin of BHP, say, over the last 5 years. We call this time trend analysis. Also, as a peer group analysis, where the company investigated is compared against the competitors, its peers, or the industry as a whole. One of the arguments against using ratio analysis is that just because some ratios are used all the time, it doesn't mean that they are the most relevant. There is no theory behind their use. Why these ratios and not some others? Who says that these are the best to use? Also, many firms are conglomerates, owning different lines of businesses. Therefore, ratio comparison can sometimes be misleading. Differences in accounting standards, accounting procedures, such as inventory recording choices between LIFO and FIFO, and fiscal years add to the problem of ratio analysis. For example, in the UK, the fiscal year ends in 31st of March. In the US, ends in 31st of December, and in Australia, the end of financial year is 30th of June. Imagine comparing firms across these different countries that have different financial years. It will be very misleading because we're not comparing apples with apples. This is the end of Module 2.